In this video, we're going to take a look at a high-paying monthly dividend investment that I never see anybody talk about, which I think is strange because considering all of the features that it has and the long track record it has, I think you'll also wonder why you never hear anybody talk about it. This fund not only yields over 11% and pays monthly dividends, but it also has been around for over 30 years and it's never missed a dividend payment. And up until recently, for several decades, this fund even beat the S&P 500 pretty consistently. The dividend holding we're going to take a look at today is called the PCM Fund, ticker PCM. According to this fund's description, it says, supported by PIMCO's renowned credit research and analytical capabilities, this fund seeks to achieve high current income as a primary objective. Capital gain from the disposition of assets is a secondary objective. The fund has the ability to invest in agency and non-agency guaranteed mortgage-backed securities, investment-grade corporate debt, high-yield corporate debt, and commercial mortgage-backed securities. Additionally, the fund may also invest in credit derivatives, such as credit default swaps and other derivative instruments for gaining synthetic exposures. The fund may invest without limit in securities that are, at the time of purchase, rated below investment grade or unrated, but judged by PIMCO to be of comparable quality. PCM was launched all the way back in September of 1993 and is offered a mostly stable dividend distribution. At the very beginning, PCM was paying a little over 9 cents per share before going through a dividend cut in 2007. When that happened, it was reduced to 7 cents per share before being increased a few years later back to 8 cents per share. So today it's paying about 1.38 cents less per share per month than it was back in the early 90s, which is pretty good compared to a lot of other closed-end funds. You can also see that throughout its history, it's paid some pretty hefty special dividends at times, although they've been pretty inconsistent. Even if PCM didn't pay these special dividends, it would still be a really good performer. Now, despite the excellent dividend track record of PCM, it actually doesn't look too good from a share price perspective. According to Google, PCM is currently down 42% in share price since its IPO in 1993. This looks pretty terrible, right? How on earth could this thing possibly beat the S&P 500 like I mentioned at the very beginning? The answer to that question has to do with reinvesting the dividends. To get a full understanding of the total return of PCM, or for that matter, any income investment, we have to use a dividend reinvestment calculator. The one that I use the most is from Dividend Channel, and it'll show you the total return of a dividend-paying stock or fund with dividends being reinvested. It only goes back to 1995, and PCM was launched in late 1993, so we won't see a full picture here. But going back as far as possible, we can see that over the last 28.79 years, PCM's provided an average annual return of 8.94% if you reinvested the dividends. A one-time $10,000 investment would leave you with over $117,000 today, and you'd now be earning $1,082 a month in dividends. Using this calculator, we can also compare PCM to the S&P 500 over the exact same time span. Up until recently, PCM had a long history of beating the index. You can see the black line almost always comes out on top over the blue line, which represents SPY. There were periods where they were neck and neck with each other, but for the longest time, PCM just had the upper advantage. So after looking at everything PCM has to offer and has continued to offer, it looks like a pretty appealing investment. In terms of dividends, it's only paying about a penny less per month than it was 30 years ago. Sure, its share price is down pretty considerably in the last 2 years because of interest rates, but it has a lot of characteristics that make it an ideal income holding for someone who's retired and wants to maximize their monthly dividend income. And while all of that could potentially be true, and it's hard to argue against a 30-year track record like this, if we lift the hood and see what's actually inside of PCM, we'll see that it's actually a pretty crazy and a little unnerving investment. If we look at PCM's investment portfolio, we can see that by far its largest holdings are in non-agency mortgage-backed securities at a whopping 50.16%. These are basically pools of mortgages that aren't backed by any form of collateral, and they're much riskier investments than agency MBSs. It was non-agency MBSs that doomed a lot of mortgage REITs during the 2008 financial crisis, and today most MREITs won't even hold too much of this stuff. You can see PCM also holds a lot of high-yield credit debt, commercial MBSs, and some other stuff. But this is a really surprising amount of high risk for a fund that's paid such a high and dependable monthly dividend for these decades. And I was left wondering, if PCM holds a lot of these non-agency MBSs today, has that historically been true for this investment? Surely if PCM held this stuff before the financial crisis, it might not even exist anymore due to a large number of their holdings taking serious losses. So I went to the SEC's website to investigate. Using the Edgar platform, I searched for PCM and I opened one of their Form N-Qs from 2008. This report shows a list of everything the fund holds and it's reported quarterly. And this is where things got really puzzling to me, because having over 50% of your holdings in non-secured mortgage-backed securities is already pretty risky. But during the 2008 financial crisis, this fund was actually even more risky back then compared to right now. PCM in March of 2008 was made up of almost all commercial MBSs, and remember, what you're looking at was actually after their small dividend cut, which took place a year earlier. You can see they reported that 128.5% of their portfolio was made up of commercial MBSs. The vast majority of their portfolio was in multi-class mortgage debt. Even though this was in 2008, many of these investments still weren't anywhere close to reaching their maturity date. You can see a lot of this stuff doesn't mature until 2041, 2047, and even 2050. But this is pretty shocking to me. How on earth did this company manage to go through the financial crisis without cutting their dividend when it was a really difficult time for mortgage investments? If we look at PCM holdings today, we can see it does have more diversification across a lot more different holdings, which is good. There's more representation in corporate debt and collateral-backed mortgages, in addition to government agency exposure and repurchase agreements. It looks like some of this stuff is the same as it was back in 2008, so they must be suiting this fund pretty well. So again, this is a pretty big mystery. How has this company been able to provide investors with such a consistent monthly dividend with such high-risk holdings? The man who started PIMCO, Bill Gross, is often referred to as the Bond King for being possibly the best bond investor of all time according to the New York Times. PIMCO has a cult-like following to this day, although Bill no longer works at the company. They claim 84% of their funds outperform their benchmarks, which is pretty good odds. PCM is one of several PIMCO funds that I'd consider to be a zombie fund. This is what I call some closed-end funds that have never gone through a serious dividend cut despite a lot of challenging environments and sometimes reporting return of capital as a source of their dividends. So with this track record of performance and management in mind, should investors rush into this fund and start buying heavily? Because honestly, given its history, it kinda looks like the type of investment that you'd want to retire off of. But despite the incredible performance, I'd argue not necessarily. There's two issues with this closed-end fund that investors should keep in mind, but both I wouldn't necessarily say make PCM a hard pass. First, because of this fund's incredible performance, it currently trades at a premium, a massive premium. In fact, it's one of the largest premiums in the entire stock market today. You can see this happen not just with closed-end funds that provide consistent high monthly dividends, but also with some individual company stocks as well. The market's just simply been willing to pay a premium price for the consistency PCM has provided. So if you're the kind of investor who loves a heavily discounted investment, then PCM isn't going to be attractive to you for that reason. Second, despite being around for 30 years, PCM has never been through an environment like the one we're going through right now. Since this fund's inception, interest rates have been on the decline until 2022. You can see there were some spikes along the way, but PCM has never seen interest rates jump so high so fast like they did just 2 years ago. When this happens, it not only reduces the value of PCM's holdings, which explains the recent poor performance in share price, but it also increases the risk of defaults on their holdings, which, if that happens, will lead to lost interest and thus likely a dividend cut. So despite being a diversified fund with a great history of performance, I do think that this is a riskier environment for it. I currently have just 2.43% of my portfolio dedicated to this fund because I think that, just like with my other PIMCO funds, there is a reasonable risk-reward situation going on here. With that said, I do consider it to be a riskier investment, so be sure to perform your own research and come to your own conclusion before deciding if this is a worthwhile investment for you. Let me know your thoughts about PCM, since again, I never hear anybody talk about this thing, and if you think it's worth considering for an income holding. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.